Aditxt Inc. is currently trading at $3.75 USD, having surged by $0.61 today, which translates to a massive intraday move of 19.35%. When you see a ticker like ADTX flashing green with a nearly 20% gain on your screen, the immediate instinct is to assume that some massive news has just dropped, perhaps a regulatory approval or a sudden buyout offer. That is the expectation. You see the percentage and your brain immediately hunts for the why in the headlines. But the reality of what is happening with Aditxt right now is far more complex and, frankly, far more dangerous for the uninitiated investor. This isn't necessarily a story of fundamental triumph. It is a story of structural survival and the chaotic aftermath of aggressive financial engineering. While the retail crowd on Robinhood stock trading forums might be cheering for a moonshot, what we are actually witnessing is the violent volatility that often follows a massive reverse stock split and a company desperately pivoting its entire business identity to stay relevant. The gap between the biotech breakout narrative and the financial survival reality is where the money is either made or, more likely, lost. Let's be real about the price action we are seeing today. A 19% move in a single session for a company of this size is not just volatility, it is a volatility squeeze. If you're watching this on an interactive broker's terminal, you can see the order book is likely thin, meaning it does not take a massive amount of capital to push this stock up or down significantly. This is characteristic of stocks that have recently undergone heavy consolidation. We have to talk about the elephant in the room that occurred earlier this month. The 1-for-113 reverse stock split that took effect just a few weeks ago on November 3rd has completely altered the supply dynamics of this equity. When you condense that many shares into one, you reduce the float, the number of shares available for public trading, drastically. A lower float means that any surge in buying pressure, perhaps driven by algorithm bots or a sudden spike in retail sentiment on SoFi investing apps, can send the price rocketing upward because there simply aren't enough sellers at the current levels to absorb the demand. This is technical mechanics, not necessarily medical breakthrough. However, to dismiss Aditxt as just a technical anomaly would be lazy. We need to look at what the company is actually telling us. Most investors looking for investment help or using Schwab Intelligent Portfolios are generally steered toward stable, cash flow positive giants. You don't find Aditxt in a standard intelligent portfolio. You find it in the high-risk, high-reward corners of individual brokerage accounts where traders are looking for asymmetric bets. The company has been trying to reposition itself not just as a biotech firm, but as a social innovation platform. This is a dense phrase, so let's break down what it actually implies for the stock. They're trying to bridge the gap between traditional life sciences and the digital economy. We have seen recent communications regarding bitXbio, a strategy that involves digital asset treasuries and blockchain integration. This is the contrarian take. While the market punished them earlier this year for the failed acquisition of Apili Therapeutics, a deal that fell apart in May, Aditxt is now betting that the intersection of crypto tech and biotech is their lifeline. The volatility today is likely a mixture of technical rebounding after the post-split sell-off and speculation that their new digital asset strategy might actually catch a bid. Think about the psychological difference here. When you look at Tesla stock or Nvidia stock, you are looking at companies where the narrative is driven by product delivery, cars, and chips. With Aditxt, the narrative is driven by corporate restructuring. The plus 19.35% move today at $3.75 brings the stock to a level that invites scrutiny. Is this the floor? Or is this a dead cat bounce? A dead cat bounce, for those new to online investment, is a temporary recovery in share price after a substantial decline, caused by short sellers covering their positions rather than genuine buying interest. Given the aggressive downward pressure this stock has faced throughout 2025, seeing a sharp green candle often traps eager buyers who think the bottom is in. Comment below how many shares of Aditxt you currently hold, or if you were holding prior to the November 1-for-113 reverse stock split. I want to hear how your cost basis was affected by that consolidation. Let's dig into the volume profile. If you are executing trades on a Fidelity trading platform or checking the charts on your Fidelity mobile app, you will notice that the volume today is significantly higher than the average daily volume of the past week. This indicates that new liquidity is entering the stock. Who is buying? It is unlikely to be massive institutional funds like those managing Fidelity mutual funds or conservative Fidelity ETFs. These institutions have strict mandates about market capitalization and volatility. The buying pressure is likely coming from high-frequency trading algorithms and retail speculators who scan for top gainers and jump in. This creates a feedback loop. The stock moves up, it hits a scanner, more people see it, they buy, and the stock moves up further. It is a momentum trade, pure and simple. But we must balance this momentum with the fundamental picture. Aditxt is a holding company with subsidiaries like Pearsanta and Adimune. Pearsanta has been the bright spot in their communications, specifically regarding their work on women's health and endometriosis detection. The promise of a non-invasive, blood-based diagnostic test for endometriosis is genuinely compelling from a medical standpoint. Endometriosis affects millions of women worldwide and is notoriously difficult to diagnose, often requiring surgery. If Pearsanta can successfully commercialize a blood test, the valuation of Aditxt at these levels would be laughably low. This is the lottery ticket aspect of the stock that keeps long-term holders engaged. They are not looking at the daily chart. They are looking at the potential for a buyout or a licensing deal for that specific technology. However, the history of Aditxt is a history of cash burn. Developing diagnostic tests and immune system reprogramming therapies is incredibly expensive. In the biotech world, cash is oxygen. When a company runs low on cash, it has to raise money. How do they do that? Usually by selling more shares, which dilutes the value of the shares you currently hold. This is why the stock chart, when zoomed out over a year or two, looks like a slide to the right. The reverse splits, and remember, the 1-for-113 split in November wasn't their first rodeo, are used to keep the share price above the $1 minimum required to stay listed on the NASDAQ. If they lose that NASDAQ listing, they fall to the OTC markets, the pink sheets, where liquidity dries up and it becomes much harder for platforms like Robinhood app or SoFi Invest to facilitate trades for average users. We also need to discuss the bitXbio initiative again because it's such a bizarre wild card. By proposing a digital asset treasury, Aditxt is trying to tap into the liquidity of the cryptocurrency markets to fund its biotech operations. It's a fascinating, albeit desperate, experiment. They're essentially saying the traditional equity markets are too harsh on early-stage biotech, so let's try to crowdsource capital through tokenization and blockchain mechanics. If you're into Robinhood crypto or follow the broader digital asset space, this might pique your interest. But for a traditional healthcare investor, this screams risk. It adds a layer of regulatory complexity that most biotech companies do not have to deal with. Let's shift gears to the macro environment. We are in late 2025. The cost of capital is not zero. Interest rates play a huge role here. For a company like Apple stock, high interest rates are an annoyance, but not a threat. For a pre-revenue or low-revenue biotech company like Aditxt, high interest rates are deadly because they make borrowing money expensive. This forces them to rely even more on equity financing, selling shares, which brings us back to the dilution problem. When you use investing sites to research these companies, always look at the cash and cash equivalents line on the balance sheet. If that number is low compared to their quarterly burn rate, a secondary offering is usually around the corner. So where does that leave us with the stock trading at $3.75 today? The expectation from the bulls is that the Pearsanta clinical data will be a catalyst that sends the stock back to double digits. They believe the market has oversold the name and that the market cap is now below the intrinsic value of their intellectual property. The reality is that the market is currently treating Aditxt as a distressed asset. The 19% bounce is a sign of life, yes, but it is occurring in a downtrend. To reverse the trend, Aditxt doesn't just need a green day, they need sustained volume, and more importantly, a tangible announcement that brings cash in the door without diluting shareholders. For those of you who engage in self-investing through a SoFi trading platform